All right, let's talk about one of the biggest, most fascinating puzzles in the investing world today. It's all about a strategy called smart beta. It promised to be a smarter way to invest, right? But after a decade of hype, well, what we're looking at is a massive trillion-dollar failure. Today, we're going to unpack exactly why that happened, and more importantly, what it all means for you. First up, let's just get our heads around the scale here. I mean, this is not some small niche corner of the market. As of early 2024, investors have poured more than $1.5 trillion into smart beta ETFs around the globe. That's just a mind-boggling amount of money. And here's the crazy part. That $1.5 trillion, it's sitting in strategies that for 8 years in a row have failed to do the one thing they were supposed to do, beat the market. So the big question we're tackling today is why? Why on earth are so many people putting so much money into something that just hasn't worked for so long? Okay, to figure that out, we gotta get on the same page. Let's cut through all the marketing hype and really break down what smart beta actually is. So here's the simple idea. A normal index fund just buys the whole market. That's your beta. Smart beta, or what the academics like to call factor investing, tries to, well, be smarter. It uses a set of rules to lean your portfolio towards certain types of stocks. Things like cheap stocks or really high-quality companies that academic research has shown tend to pay off over the long run. You can really think of it as a hybrid sitting right in the middle. On one end of the spectrum, you've got your classic passive index fund that just buys everything. On the other end, you have active fund managers making decisions based on their gut and research. Smart beta is this middle ground. It's trying to beat the market, but it does it with a cold, unemotional, rules-based computer program. Now, academics kind of went wild with this idea. They came up with over 300 different factors, creating what the industry jokingly calls the factor zoo. It's pretty funny. But the truth is, most of those were just noise, statistical flukes that don't really hold up. In reality, only a few have proven to be the real deal over time. And these are the big six, the ones that really matter. You've got value, which is all about buying cheap stocks. Quality, which looks for profitable, stable companies. Momentum, which chases stocks that are already on a winning streak. Low volatility, for stocks that offer a smoother ride. Size, which bets on smaller companies. And investment, which favors companies that are smart about how they spend their cash. Pretty much every real smart beta fund is built on some combination of these. But hang on, here's our first huge problem. You see these amazing returns in the academic papers, and they look incredible. But that's in a perfect world with no costs. In the real world, you've got trading costs, you've got taxes, and the simple act of buying a stock pushes its price up. That gap between the clean theory and your messy, real-world ETF return can be absolutely massive. So let's get to the reality check. This is where the rubber meets the road, and we see how this played out in the real world. And, spoiler alert, it wasn't pretty. We're talking about a long, painful stretch where these smart strategies looked anything but. And wow, this chart just says it all, doesn't it? For 8 straight years, almost every major smart beta factor lagged behind a simple market index. Some got crushed by as much as 6% a year. Imagine paying extra for a smarter fund only to underperform that badly. That's just painful. So what went so wrong? Well, it boils down to 3 main culprits. First, these strategies became victims of their own success. Too much money piled in, making the factors expensive. Second, you had the Magnificent Seven problem, where just a few giant tech stocks drove everything. And third, that rigid, rules-based approach, it turned into a huge weakness. And this is the great irony. The very rules designed to make these funds smart, like avoiding expensive stocks or not getting too concentrated, caused them to systematically underweight the Magnificent Seven. The problem was, those few stocks were basically the entire market's return for years. By being smart and diversifying, they completely missed the party. And the rigid rules made it even worse. I mean, get this. In November 2020, the vaccine news came out, and value stocks just took off like a rocket. But a major momentum ETF, because it was locked into its rebalancing schedule, couldn't actually start buying into that huge new trend until May of 2021. It was 6 months late. The move was already old news by then. So after hearing all that, it's pretty easy to just write this whole idea off as a failure. But the story isn't over. It's evolving. So let's look at what might be coming next, what some people are starting to call Smart Beta 2.0. Which of course leads us to the billion-dollar, or I guess trillion-dollar question. Is this whole thing just fundamentally broken? Is smart beta dead? The consensus seems to be, No. It's not dead, but it's definitely having to evolve. And here's the key. After 8 years of getting beaten up, these factors are no longer popular. They're no longer crowded, and that means their valuations look a whole lot more attractive today than they have in a very long time. Historically, that's a much better starting point. So the folks creating these funds are getting smarter too. The next wave of products is focusing on mixing multiple factors together for a less bumpy ride. They're becoming more aware of valuations instead of just blindly following old rules. Some are even trying to dynamically rotate to the factors that are working now and even blend the whole thing with a bit of old-fashioned human oversight. Okay, so knowing all of that, the good, the bad, and the ugly, how should you, as an investor, actually think about using these tools? Let's put together a simple, practical playbook. Here you go, a simple 4-step checklist to keep in your back pocket if you're ever thinking about adding factor strategies to your own portfolio. Step 1, don't put all your eggs in one factor basket. Seriously, while the value factor was in the doghouse, maybe quality or momentum was doing okay. By combining them, you can help smooth out some of those brutal boom and bust cycles that make it so hard to stick with a single strategy. Number 2, and this is maybe the most important, valuation matters a lot. The biggest mistake everyone made was jumping on the bandwagon after these strategies had an amazing run and got expensive. The time to get interested is when nobody wants to touch them, when they're unpopular and cheap. Third, think about taxes. Here's a weird silver lining. For people who held these in a regular brokerage account, all that underperformance created opportunities to harvest tax losses, which is actually valuable. But in general, because they tend to buy and sell a lot, these strategies are often a much better fit inside a tax-sheltered account like your IRA or 401k. And finally, step 4. This is the hardest part for any human being. Discipline. The whole game with rebalancing is to sell what's popular and has done well, and force yourself to buy what's unpopular and has done poorly. It feels completely wrong, but it is the absolute key to making factor investing work over the long haul. Which really leaves us with this final thought to chew on. The crowd rushed into smart beta when the story was fantastic and the prices were high, and they got torched. Now, after 8 years of terrible performance, the story's awful and the prices are cheap. So you have to ask yourself, is now the truly smart time to be taking a look?